next few months, yeah, through year end. I think that's right. I mean, we always know that September is a bad month, but you've got to discount that historically. But I mean, generally, I think it's okay. I
Yeah,
think
I
there
mean,
will
we
be
will get wiggles and we'll get
yeah.
liquidity withdrawals and all of that stuff, but the trend is intact and continues for a while.
There are too many bears out there, to my mind. I mean, people want to call the top of the market, and I think that's always problematic.
Yeah, totally agree. But although the other side of this is we're all kind of expecting yield curve control in some way, shape, or form at some point, just because of the debt refinancing mechanism. And one of the things is interesting is, and I only read about this morning, that there is some changes in the Federal Reserve Act that may allow them not to pay interest on bank reserves, which would force it into the bond market. That feels like, a backhanded way of yield curve control by forcing banks to go further out the curve.
Hey guys, welcome to Everyday Finance. At the beginning of a market cycle, there is hope. In the middle, there is progress. And at the end, there are rising risks. How far along are we? That's the big question right now. Cash flow is important to Raoul Pal and Michael Howell. Howell points out that the global cash cycle has been going for 34 months, which is a long time in terms of history. Pal agrees that the circle has reached its end, but it's still not quite there yet. That doesn't mean a crash is coming soon, but it does mean that this stage will be marked by big debt refinancing and record corporate spending. Especially from us tech giants putting billions of dollars into AI, the main point is that markets don't move in line with normal business cycles anymore. Instead, they move mostly based on amounts of cash. What's more important than GDP, inflation, and what the central bank says is how much cash is being pumped into the system. This can be done by issuing T-bills and growing bank balance sheets. The end game could last until 2026, but the way there will follow cycles from the past, like the late 1980s, and set returns for stocks, bonds, and crypto.
Let's assume that most of the world's major central banks know the game is debasement of currency and they're all having to do it together to refinance debts. Then part of their job is to offset some of that. So if you've got to go through a debt refinancing cycle, the dollar has to weaken for everybody. Well, then the most likely outcome is they end up diversifying dollar reserves out into an asset like gold. And we've seen, certainly in the Middle East, Bitcoin being put on, various parts of the sovereign wealth fund balance sheets. So it seems very consistent with them understanding. The great one to me, the greatest of all, I think, was the Swiss National Bank, because they kind of figured out what the game was. Yeah. Because they're at all the meetings, but they're too small to matter. I remember meeting them years ago and they were like, we can do anything we want because we're too small to matter. And what they did, instead of kind of managing this process, they just bought tech stocks, which was genius, because that was the right thing to buy.
Exactly. Yeah, exactly right. I mean, that's right. I mean, maybe we look to them first as be the official buyer of Bitcoins. It's entirely possible.
Yeah, because, everyone thought, well, what are they, crazy? They turned into a hedge fund, but they figured out, well, debasement, you might as well just buy the asset that outperforms the debasement. And their balance sheet's been great, which has kept the Swiss francs strong over this whole period, or steady over the whole period.
Yeah. But I think, the other thing is, which I'm sure you've got an opinion about as well, is about the role of stablecoin and how this gives a conduit to the Treasury and Besant to actually do a lot more funding. I mean, this could be big. And I think it's, if you start to look at how stable coins operate, typically, I mean, you could make a case. And in fact, I've sort of argued negatively in one regard to say that, a big growth in stablecoin could actually dent bank credit significantly, because actually a stablecoin is a lot more, or a stablecoin issuer is a lot more constrained than a bank. And if a lot of funds move from banks into stablecoins, you're not going to get credit growth, which is clearly a possibility. But then you've got to think about it from the other side, is that actually it's a wonderful source of credit for the Treasury. And so this is what you're going to get, is much more public sector led credit growth via the stablecoin conduit. And it's really an opportunity, in no other words, for governments to print money.
What's interesting is those of us who've been around a long time, we grew up with the Eurodollar market. The Eurodollar market was the wholesale funding markets of the dollar, but that stopped at like the big Japanese banks, the European banks and stuff like that. And then you had to get access to it, and it was restricted down to others. It was hard to get hold of dollars outside of that, but that was the big dollar funding market. What stablecoins essentially is a fractionalized Eurodollar market down to individual level. So it means you can be in any country in the world and get access to dollars, which is an extraordinary thing. And so what you're doing is spreading the dollar and the issuance of bonds and the holding of bonds down to individuals all around the globe.
Yeah, I think it's a revolution. I think you can see why it's so important, given the sort of sudden change of heart by the Europeans, who were sort of dragging their feet hugely on some equivalent euro currency, and now they're basically going full steam ahead.
And are they going to do it via the central bank digital currency route, or are they just going to let the open market just build to try and spread demand for euros? Because
I think given the fact it's Europe, it's got to be the central bank route. They're not going to let the private sector get in there, but that's what they should be doing.
Yeah, and let's see whether there's actual demand for euros on a globalized basis. It feels like it's a dollar world, and it's the US.
But I think they're running scared because they realise that they could be wiped out or smothered, crowded out, in fact, by dollar stablecoins.
And even your chart of showing the amount of money piling into the US shows that crowding out is happening. And that's what we're seeing in the UK and the French bond markets, essentially, is there's not enough foreigners who want to finance other countries' debts. We're seeing, whether arguably maybe in Japan as well, there's not enough demand because everybody would rather finance the US. Yeah,
I think absolutely. I think that's the reality of that chart, but it's been the reality for the last 15 years. That there's a lot of money that has flowed into the US because the US is the bond market, it's global collateral, and they've got on top of that the added icing on top is the tech sector.
So, final question for you. So, do you think the rate of debasement or the increase in liquidity, the rate of change increases from here, going into this whole big, large refunding period? So we should see a spike in all of that, or is it kind of more as steady as she goes?
The way that I think about it is to go back to this chart, which is looking at the ratio between debt and liquidity. And what this is really saying is that over the long term, financial stability demands a stable debt liquidity ratio. This is for the advanced economies. If you get debt growth, and I think debt growth is, let's take the US as a decent benchmark, debt growth is likely to be growing at something like 8 to 10% per annum, or that sort of magnitude. Then I think what you've got on top of that is equivalent liquidity growth, because you need a stable debt liquidity ratio. So liquidity has got to grow at pretty much the same rate. Now, what we know is that a lot of those projections, and I tend to use numbers that come from the Congressional Budget Office, for want of any other source, they give decent long-term projections. The problem with the CBO numbers is they don't take into account recessions. And we know that recessions basically lead to big deficits. And in the last couple of recessions, the US deficit's blown up by 4 to 5 percentage points of GDP. So you could be seeing actually a lot faster potential growth of debt anyway. So I think that these figures are of sort of 8 to 10% minimum figures. And that's what we ought to be thinking about. So, in that case, you've got to choose assets that are likely to give you that sort of return over the medium term. And there's not that many around. Certainly bonds don't do it. Next few months, through year end, I think that's right. I mean, we always know that September is a bad month, but you've got to discount that historically. But I mean, generally, I think it's okay.
We will get wiggles and we'll get liquidity withdrawals and all of that stuff, but the trend is intact and continues for a while.
There are too many bears out there, to my mind. I mean, people want to call the top of the market, and I think that's always problematic.
Yeah, totally agree.
Michael Howell says that we are nearing the end of a money supply rise. There will be a lot of borrowing in the debt markets, and trillions of dollars are leaving the money markets as tech giants put money into AI. The usual business cycle is no longer important. Instead, liquidity has become the main factor. Howell refers to the Treasury's large bill issuing as Treasury QE. This keeps volatility low, pays for deficits, and adds liquidity. Even though this may make the cycle last longer, Howell warns that it will still end in the normal way, with inflation. That makes the Fed the center of attention. Politicians are putting pressure on the Fed to lower rates, but Howell doesn't believe the Fed has much power. He thinks that long-term rates set Fed policy, not the other way around. Also, with nominal GDP at about 5%, rates naturally have a floor. Balance sheet moves, controlling the yield curve, and rules that force banks to take on government debt are now the bigger levers. In other words, structural pathways instead of traditional monetary tools are being used to create liquidity. This changes how banks, deficits, and monetary inflation interact with each other.
Yeah, and both of our hypotheses is, long duration assets tend to do very well in that environment, and we've seen that with technology stocks and crypto. Gold has acted very well in this environment, as it should do. And, all the signs are there that the debasement is ongoing and it's not going to go away. One of the things that is interesting to me is obviously Trump and Bessent are focused on what they can do with the Federal Reserve. The shenanigans around changing the governor and various board members. Clearly, they want to see if they can force interest rates lower. I think personally, interest rates are too high versus GDP or whatever your kind of real interest rate measure you look at. And that there's room for rates to come down 200 basis points, which allows them to refinance again. Any thoughts on the kind of Fed board shenanigans?
Yeah, I mean, I'm cynical enough not to think it really matters too much. I mean, at the end of the day, I don't think the Federal Reserve really controls interest rates, certainly across the curve. I mean, it's rather the other way around. Long-term rates tend to drive the Fed rather than vice versa. So, ultimately you've got to say, well, okay, what's the fair value for the long-term bond? And that has to be related to nominal GDP growth ultimately. So you're talking of something like about 5%. And then you take what is a normal spread between the short end and the long end. What is it? 125 basis points. So that gives you your benchmark for Fed funds. So there's not much they can do sort of either side of that. And they can dance on the head of a pin and come out with their projections. But in reality, the FOMC doesn't have that much sway, I don't think. It's really a signaling tool more than anything else, as far as I can see. What matters more is really the balance sheet, what they're doing there.
Yeah, I mean, although the other side of this is we're all kind of expecting yield curve control in some way, shape or form at some point, just because of the debt refinancing mechanism. And one of the things is interesting is, and I only read about this morning, that there is some changes in the Federal Reserve Act that may allow them not to pay interest on bank reserves, which would force it into the bond market. That feels like, a backhanded way of yield curve control by forcing banks to go further out the curve. Does that factor in at all?
Yeah, it could be. I mean, I think there's a lot of it. All these things that they're lining up. Whether it be elimination of the SLR, the supplementary liquidity ratio, whether it's changing stress test rules. All these things are really trying to give the banks more capacity to buy government debt. And we know ultimately this is what tends to happen in a monetary inflation. Banks tend to come in and buy government bonds, then monetize the deficit. And that's the route to funding. The question is, how quickly are we going to get there? Or how quickly we get there and inflation really becomes the issue. I think they can probably push inflation down over the longer term. And I think there's a lot of factors in there in the equation, as you will know, things like AI, which are probably going to depress consumer prices. But at the end of the day, what makes all this very confusing in a way is that high street inflation is very different from monetary inflation. And you can have a background of strong monetary inflation, but because you get, cost deflation, in other words, productivity wins or cheap Chinese goods, the high street's less affected for some time. And ultimately, investors have got to invest around monetary inflation, the debasement of the currency, much more than what they're seeing in the high street. But it will come through in the high street at some stage.
Yeah, and it usually comes up as the business cycle picks up as well, if it does pick up, which I think it does. The other thing that's been interesting to me is the shift in how the Fed and the Treasury have kind of managed the debasement. It started simply with the balance sheet. Then everyone kind of figured out that game, and then it turned into this Fed net liquidity game. And now it's gone to what we look as a total liquidity, which is including the private sector, because they're now using the banks as their main mechanism of debt monetization. Does that make sense to you?
Makes complete sense. Absolutely. I mean, I can put up some charts if you want me to
go
demonstrate what
always
what
love a
we
good
do.
chart.
So, in terms of where are we in the cycle, this is our liquidity cycle, which goes right back to the 1960s. And the sine wave there is something that we fitted back about 20 years ago in the year 2000 to show you've got this 5 to 6 year cycle, which is, I think, different to the way that you see it in terms of a 4-year cycle. But
Michael Howell and Raoul Pal both agree that we are in a late-stage liquidity upswing, but they look at it in different ways. Howell is in charge of time, duration, math, and the details of Treasury Q e-bill issuance, and regulatory pushes on banks to make deficits monetizable. He says that soon there will be debt repayment, capital drains caused by AI, and structural changes that will lengthen the cycle, but plant the seeds of monetary inflation. Pal looks at liquidity from a higher level, seeing it as a political and story force. He sees pressure to lower interest rates, the limits of what the central bank can say, and the general trend of debasement of money. He thinks of liquidity as reflexive fuel, which means that markets will keep looking past weak factors as long as liquidity flows. They draw a bigger picture together. The story tells us why investors keep betting on the engine, while the mechanics explain how long it can run. Both of these signs point to long-term assets like tech, gold, real estate, and especially crypto, which lives on people looking for quick cash and high returns. Be careful, though. Howell's warning means to reduce your risk, hold on to your defenses, and reduce your exposure. In Pal's view, you shouldn't rule out the chance that policy and structural changes will make the cycle last longer, which would open up more opportunities for the upside. For crypto, the imbalance is clear. In a world driven by liquidity, assets that are hard to get and have strong networks can make huge gains even during late cycle instability. Hold quality long-term exposures, size them wisely, hedge tail risks, and keep dry powder for pullbacks. This is the easy but disciplined playbook. What time it is and where we are in the cycle are both shown by Pal and Howell. They also explain why markets keep running on liquidity. The plan is to be alert and open to opportunities, ready to ride the upswing, but also ready for the expected turn in the late cycle.